So my probably one of my first questions is in terms of execution. When when you or an investor out here would be buying international stocks or doing some of this themselves, what kind of liquidity constraints do you run up against? What kind of execution challenges do you have in some of these markets?
Well, I don't manage as much money as you do, so my problems are less. That would be a great problem to have someday. But obviously, if you're going to try to transact in Colombia or a lot of these frontier markets, it can be very challenging. Thankfully, most of the markets we transact in are liquid. We're looking at fairly liquid, large companies. So it hasn't been much of a problem yet. If we raise 10 to 50 billion, will we have to start to narrow the universe? Maybe. The good news is we're only rebalancing once a year, so transactions are pretty low, the costs. The bigger problem is just to kind of hold your nose and stop reading the newspaper challenges. But as far as liquidity, it hasn't been much of a problem. Exception, what are the two? Our brokers don't like to execute in Brazil or South Korea for whatever reason. Those are more challenging, but so far it hasn't been too bad.
And when you're putting together portfolios, the Ivy portfolio is a really good example of, I think, a strategy. One of the things that is fascinating about well-diversified portfolios, and one of the reasons why we have multiple funds is that if you take any particular asset class and you overlay it with some of the things that you're talking about, valuation, market action. We talk about market action in different ways, but if you use a well-defined strategy that outperforms the market over the long run in that, and then you diversify across multiple markets, all following essentially a strategy that's based on that, you end up getting much more consistent returns. It doesn't add to your return any more than any of the particular markets because it's just a weighted average on the return side, but you end up getting a lot less drawdown. And one of the things that I really liked about Ivy portfolio was bringing that part of it out. And so maybe talk about
what's interesting about buy and hold allocations. We did a study that looked at about a dozen of the most famous allocations. So 60-40 endowment model, risk parity, Bernstein, coffee, lazy portfolio, every possible allocation you could think of. And strangely, over the past 30 years, they end up all kind of in the same place because most of them have exposures to broad asset classes, equities, bonds, real assets, right? And so the amount and effort that people go to on the asset allocation decisions, while they may vary in the short term, you see this a lot in the institutions where the endowment model becomes popular, then risk parity becomes popular, and then that has a terrible year. A lot of the basic asset allocations end up very similar, but then you start to think about doing things that are different. One of the things we use in our global tactical funds, of course, is trend following, which has been a horrible place to be the last 4 years. And you're starting to see that because so many managed futures funds are going out of business. But that's a great example of cyclical type of variations of strategies, valuation, doing certain things that while you should have them in your portfolio, doesn't mean it's any less challenging to stay the course on those strategies. And managed futures, which I love, I think it's way too expensive, but as a strategy, one of my favorites, a lot of those guys are going out of business now. The largest currency strategy fund went out of business last year. But to me, those are good contrary signs more than anything, and usually that's one of the best diversifiers. But the challenge is, of course, staying the course and committing to a long-term, and you don't just see this retail. You see this with institutions all the time. There was a group that ran an endowment portfolio and switched to risk parity at probably the worst possible time. And then, but that's the biggest key. Most investors stated long-term time horizon really have a short-term preference.
Yeah. You mentioned Jim O'Shaughnessy, and one of the authors of the author of one of the best books that I've ever seen, which is What Works on Wall Street, because we're like you and like Jim, very data centric. Do it because you've demonstrated that it works. And what's interesting about that is when Jim came out with his first set of funds, things immediately did not work because he came out, I think, in the late 90s, and the strategies that he had developed just did not perform over the first several years, and he ended up selling out. And now, you know, and those strategies have since gained their mojo back, and Jim O'Shaughnessy's strategies are exactly the same basic focus, which is some combination of valuation and market action, unless you're talking about deep value, in which case you use some combination of value and quality. And
that's kind of the irony of the trailing performance, where everyone wants to allocate to the best performing managers, and typically on a 3 to 5 year time horizon, you should probably be buying the worst. You know, the Morningstar star system is probably the exact opposite of what it should be. Yeah. Which is challenging, but that's, you know, that's why the perfect example is Huebner's CMG fund, CMG Focus, portfolio manager of the decade in the 2000s did like 14% a year or 12% a year. The average investor in that fund did minus 10%, right? Because they bought it after a 70% run up, and then after he had a 70% drawdown, sold it out. It was a great example of that exactly.
Yes.
I have a question. Stephanie enjoyed your charts and Confessions of Ben Bernanke, but given his sort of academic background and given his study of the Great Depression, didn't he accomplish exactly what his academic background and his conclusions of the Depression were, now that he's exited? And so the question for the whole group, based on all of you, is that this time is different. Why or why not?
Well, I guess my feeling is, again, that, you know, he succeeded in terms of reinflating assets. I happen to believe that he hasn't yet succeeded in generating a wealth effect. And that really was the objective, was to really to get the economy going, not just to inflate assets. And while some of the headline data, like this morning's employment report, might suggest that he accomplished that mission, I think when you drill down and you look at what's really going on, like, again, in this morning's report, you know, you had a massive decline in the labor force, and labor participation, you know, dropped again to the lowest, I think, since 1978. So beneath the surface, there are a lot of things that suggest that we really haven't recovered at all. And I think, you know, it's important to distinguish between what's happening on Wall Street from what's happening on Main Street. And so he definitely succeeded in the first part of that. And I think, again, you know, his objective was to see this wealth effect set up, and their feeling has been, well, we'll give it a little more time. You know, we had the worst deflationary bust in our generation. So it's going to take longer for people to get over the emotional and financial scars and get back out there. It'll take longer for a wealth effect to set up. But, you know, 5 years on, it still hasn't happened, and they're running out of gas here. You know, the stock market is at extremes. Risk appetite is at extremes. So I'm not really sure what the next rabbit they're going to pull out of the hat is.
I'll throw an additional comment out. If you look at the narrative that led up to the 2008 credit crisis, people were reaching for yield. You had investment banks looking to sell more product, and the only way you could do that was create a lot of mortgage securities, not really caring about who got those mortgages as long as you could get the product out the door. Once we had the collapse, it's certainly true, I think, that the Federal Reserve's initial response to make sure that banks were liquid was exactly appropriate. The job of a central bank is to make sure that there is liquidity, that there's a lender of the last resort, in the sense that you follow what's called Bagehot's rule. And Bagehot's rule, named for a British exchequer, is basically that you lend freely to credit-worthy borrowers at a high rate of interest. Why a high rate of interest? Because you want to get them repatriating, giving back those loans as soon as they're not needed. And in fact, Warren Buffett it really followed exactly Bagehot's rule when he made his investments in preferred stock. He got very high interest rate preferred stock in return for capital. So Warren Buffett was the perfect central banker during the credit crisis. Ben Bernanke was not. The thing that they did do, the first round of quantitative easing with mortgage securities, was important in the sense that it really did provide a funding source for housing in a situation where housing really would have come to a standstill. But there was really no Bagehot's rule involved with any of the late 2008 crisis. And my view is on the recovery since that the singular event in turning that crisis around was in early March, about March, I think 17th of 2009, when the Financial Accounting Standards Board, under pressure from Congress, eliminated mark-to-market accounting, said you could use significant discretion. At that point, it wasn't clear that investors would believe it or that regulators would go along with it, but in fact, everybody did, and that was the end of it. These exercises in quantitative easing, I think, have been very strong on the sentiment side, very strong for investors' belief that the Federal Reserve is actually controlling something, but really what quantitative easing has done is driven another set of yield-seeking behavior that has very, very, very little relationship with real economic growth. And I think that's why now that Ben Bernanke is gone, the other members of the Federal Reserve don't have any particular taste for it, including Janet Yellen.
So there's this chart here on loan loss reserves, which presumably when you're not marking the market, it's a little bit easier to free up those loan loss reserves. Do any of you have any sense for how important this has been, and I would presume these are mostly financial companies' earnings, to the overall level of earnings of the S&P of late?
Well, doing apples to apples, the growth in financial earnings over that same stretch, was about $100 billion. So it explains all and then some. I mean, the loss release explains all and then some of the earnings from financials.
And then what about financials relative to the rest of the market? I mean, have they been an important part of keeping S&P earnings where they're at? If you have a sense, I don't know.
My sense is some, not not predominantly, basically because if you look at financials going into the crisis, they were a much larger fraction of market capitalization than they are now. We're looking at a market cap on U.S. equities generally of upward of $16 trillion. So you figure at a price earnings ratio of about 20, you take about 5% of that, and you've got about 800. Wait, is that right? 800 billion. Yeah. And so you're talking about a change in earnings of about 100 million. I mean 100 billion in there. So it's some significant amount of the earnings total. It's been some significant amount of the earnings growth, but it doesn't drive the whole story. Yeah. Yes.
Great presentations. Thanks to all of you. I want to follow up on a comment you made briefly, John, in your presentation. It's a genuine question here. You quickly remarked that if there's anything left in capitalism, if there's any part of capitalism which is still alive, this all holds. I read your weekly comments, and you're very generous with details, and I find your presentations and your perspective very compelling. But I'd like to ask if there's any policy actions, either from the Fed or on the fiscal side, no matter how reckless, that you could envision that would undo your analysis and your perspective. And this is for everybody because you've got related ideas, and if anyone else wants to comment, I'd appreciate their response too.
Yeah. Well, so the question is, are there any policies that the Federal Reserve or the central government could do to kind of undo the hypothesis and presumably, I guess, maintain stocks on an upward trajectory indefinitely and so forth? So my sense is that 2013 was for us a whole lot like 1999. We did not party like it was 1999 in 1999. It was not pleasant at all because basically valuations were stretched to an extreme, and we had a remarkable blow-off into 2000. And we experienced essentially the same thing in 2013. So my sense is that given where we're at, we are looking, I think, very objectively at 2.4%, likely 10-year returns. It's possible for the Federal Reserve to do something, say equity prices go down some, and then they get scared for some reason, and they decide to try and bring back, the mojo, try and bring back speculative, tastes. And those kinds of actions have two potential effects. One is to further defer the sort of regression of valuations to typical norms, and the other is to press prospective returns even lower. Because certainly, as Meb was saying, we had a Shiller PE of over 40. In the tech bubble. So could that happen again? Yes, it could, in the sense that there's nothing that you can really prevent, and we've learned this over time. Investors, to say no, stop, don't. You're doing something that you're going to regret over the long term, because back in 2000, by the peak, you had stocks priced for a decade of negative 5% annual returns. So how much do you have to push stocks up to get from 2.4 positive to negative 5%? Well, you figure every roughly 10% advance in the market takes away another percentage point from 10-year returns, because it's a give and take. So in that sense, you can't rule it out. My sense is that nobody on the Fed right now has any of the affection for quantitative easing that Ben Bernanke did. So I think that's a relatively low prospect, given that they really do seem to want to go back. What it may do is it may defer, any material or really deep decline for a while until we get some period of economic adjustment where you get economic softness. And then the Fed's actions, at least if you look at 2000, 2002, if you look at 2007, 2009, the Fed's actions really don't have a whole lot of effect in turning around an economic decline once it gets going, until that decline is really played out to a much greater extent. On the fiscal side, if we were to get a real taste to go back to a big deficit, that could certainly and have some sort of a massive government spending plan put into action, which I don't think is the prospect until we get some economic weakness first. But if it did, that would have a tendency to help hold up profit margins for reasons that we've talked about earlier. But I don't see any long-term dynamic shifting. It's mainly how much do we defer this? And we've deferred it for quite some time already. We've gotten sentiment extreme. We've got a lot of reckless lending going on already, and I think Stephanie would agree on that. The types of things that we're seeing, both in sentiment, in overvalued conditions, in sort of the early breakdowns that we're seeing now in the momentum stocks and other sectors, which kind of tell you that there's a very subtle risk aversion coming back in the market, concerns me that it's not different this time. It's just we've deferred it to a point where we're starting to see cracks. Whether those cracks end up becoming fissures and really get a significant decline going depends a lot on whether investors believe any new psychology that comes from Fed action or something.
Sure. I guess given the valuation level of the stock market, the outlook for whether they can sustain valuations, I would, have a question about. They might prevent a severe decline by implementing pro-growth fiscal policy. I agree with John. I don't think there's very much that the Fed can do anymore from here in terms of QE that's going to be beneficial. But I'm asked frequently, what could go right, which is sort of, in my case, the nightmare scenario. And I spend a lot of time at night staring at the ceiling thinking about what can go right. And for me, the thing that's terrifying is the $2 trillion that's sitting on corporate balance sheets in cash. This money is literally burning a hole in their pockets at 0% real interest. You have to imagine that the only reason that they're sitting on this cash, apart from the massive amount that's held overseas that they have no incentive to bring home, but the money they've got here is that there's just no compelling investment. They don't see the rationale for putting that money to work. And it wouldn't take much to impel them to do that. I think if there was some pro-growth corporate tax reform, they tried this before, but if they tried to do a foreign tax repatriation and tie it to some kind of hiring or CapEx type of thing, I know it didn't work so great the first time, but we're sitting on a lot more cash right now. And so far, they've waited a long time to undertake that kind of CapEx and domestic expenditure, so it might be more effective. But I would think that's really the impediment, because the reason, in my view, that the wealth effect hasn't set up is that employment hasn't picked up as it should have. So we're relying on asset inflation, and we're trying to rely on asset inflation to spur spending after the worst deflationary bust. I mean, psychologically, you can inflate assets to the moon, and people aren't going to feel compelled to go out and spend unrealized gains. They learned that lesson before. They're not going to make that mistake again. They need actual cash, cold hard cash income, and they're not getting it. And until that happens, and until the government tries to, either that happens naturally or there's fiscal policy that tries to encourage that to happen, I don't think there's really much that can happen.
And I'll add one more thing on the cash side to sort of relieve one of your nightmares. Is if you look at the amount of debt that companies have accumulated over the same period, it really overshadows the amount of cash. So yeah, so basically what they've done is they've issued a debt at very low interest rates, and they're sitting on that cash. So the question is, do they have a use for it, or is it a financing mechanism? And what has really been happening to some degree is people, some of these companies have been doing these buybacks, right? Because they're basically saying, well, look, I can issue a corporate bond at 2.5%. I can buy equities, and their CFOs are telling them that the implied sort of weighted average rate of return on their equity is much higher, right? So what are they going to do? They're basically going to go out and they're going to buy those stocks in, thinking that they're doing themselves a favor. My concern is that they're not valuing those equities properly. They're assuming that the cost of capital is still 7, 8, 9, 10%, and the cost of capital looking out a decade is something about the same as they're paying in interest. So I think these buybacks are actually rather harmful.
And typically CEOs are horrific at the timing of buybacks, right? It's a very cyclical behavior, and they see them as something to do with cash that's sitting around, whereas CapEx and dividends are much less volatile, and it's how companies run their business. But as you saw with 07, 08, they batten down the hatches, they stop buying stock when they should, and then now you've been seeing the buybacks pick up, and it's a cyclical top type of indicator. The one thing, in my opinion, that's been missing that you're now seeing is M&A. And M&A has been slow this cycle, but is really picking up quickly with a lot of these mega deals that are getting announced. But again, something, if you look at an M&A chart, it's very similar to buybacks, very highly correlated to market tops.
And also not confirmed.
Right. But
harm the effectiveness of shareholder yield?
when you have a shareholder yield approach, which is dividends and buybacks, investors are typically agnostic as to how they get the money as long as they get them. But what's most important, and Buffett talks about this, is you want a company that's trading below intrinsic value. And as a value investor, you'll never be buying technically expensive companies because you have a valuation methodology or screen, right? So you'll never be buying the companies that are buying their stock that are also expensive. You'll be buying the ones that are cheap. Like Buffett says, when Berkshire gets to, 1.3, 1.2 times book, I'll be buying it hand over fist. And it's close, it's gotten close. But you need to, in my opinion, you need to have an objective methodology. And most CEOs don't, right? They're empire building, our stock is always cheap. And so buying it back on a consistent basis, but it's very important to have the valuation methodology.
That's the real risk. I mean, I did an analysis of this, and there's really only about a dozen or so companies that really actually have cash. The rest is debt. And the risk would be actually not that they use this money to buy back stocks and that pushes them higher, but that it puts them in the same position that they were in 2007. These companies were priced for bankruptcy as if they could not get cash again in 2007. That's why the stock market plunged as much as it did. If they can avoid this now, it's debt. They can use it to finance themselves if there's another credit crunch. If they blow it on stock buybacks right now, well, where are they when the next credit crunch comes?
And to some extent, really the cash, sort of acquisition, which is again not so much retained earnings, but it's literally debt issuance, and the opposite side of that on the asset side of the balance sheet. That cash is in some sense substituting for an operational commercial paper market that just went out of business, back in 2008 and really hasn't come back.
I would just say to Mish's point that if you look at the S&P 500, the top 25 companies lay claim to more than half of the cash on the balance sheet. The bottom 250 hold all the debt. So the skew in the corporate sector is worse than it is in the consumer. When we talk about how the low end has all the debt and the high end has all the assets, it's even more pronounced in the corporate sector. And so when people talk about corporate debt and they paint it with one broad brushstroke, you have to be very mindful that, there are 25 companies that are great and the rest are all struggling to keep up. And because of the abundant liquidity provided by the credit markets right now, junk companies have been able to compete in this dividend share buyback bonanza because money's free. But I think you're absolutely right. I mean, we're really compromising balance sheets, and that'll become clear in the next downturn.
Going back to the long loss reserve release of financial institutions once again, I agree that it occurred. It counts for a great deal. It happened. I guess the question for me is, should it have happened? Should they have done it? What's your opinion?
Well, I think, the suspension of mark-to-market, obviously, my sense was not the shrewdest decision and just sets us up for more disappointment down the road. So I think they were a little aggressive with this. I also, because I'm concerned about the sustainability of the recovery in the real estate side, I think that they were a little premature in releasing the reserves there too. I mean, they already are holding less reserves than they have in past due loans. So it's going to be a problem if any of those past due loans actually do go belly up, which seems like a high probability to me. So I guess that was sort of a softball pitch down the middle for me. I don't know about you guys, but.
Can you speak a little bit to this issue of bringing cash back? Now, my impression is that they have on the books, the corporations have on the books, a liability associated with the tax of bringing the cash back to the U.S. So from a P&L perspective, it doesn't hurt them if they bring it here, but it does physically reduce the amount of cash because it goes from being a liability to actual cash out the door. Are there any other gains that are considered that are a factor here, other than the fact that they're they're actually having to pay off a liability?
My impression on this is, I mean, it's essentially a tax arbitrage. I mean, and that's really, why you're starting to see some of this, some merger activity as well. That's trying to basically game the differences in taxes. Do you have a question? Because I maybe. eBay chose to get smacked. Yeah. Yeah, no, it is definitely so. No, I don't want to suggest that it's not a real cost to repatriate. I think the reason that they don't is exactly that is that they get smacked, and so there I think is very likely going to be some sort of corporate tax treatment that tries to get at that issue, because government finances are such that that I think on both sides, people would like to get better clarity in terms of how we treat foreign repatriated foreign earnings. I think on the Democratic side they want to get more revenues. I think on the Republican side, they don't want to have capital that's locked and doesn't have the ability to move where corporations want it to. So there will be some changes, I think, in corporate tax treatment over the next several years, but it's not clear what that's going to be. JJ, I think we.